What's going on, everybody? Sit Down Sunday. I think this is number 4. Today we're going to be talking about options in the option chain. I had a really good comment from Dario. Shout out to you. Thanks, my man. If you talked a little more in depth about options, like in front of the option chain, why you did this, strike prices, the risk on it, etc., a lot of people would follow and love it. So I'm going to do just that. Please let me know what you think, or at least what I should do for the next one, because I always run out of ideas on what to do for these videos. So please tell me what to do. I will do it. So let's just take the SPY, for example. A lot of people start off on the SPY because it's cheap, it's very easy to manage risk, and the options are super liquid. So this is the chart. I'm going to put the chart down here. I unlinked it because I'm going to drag over, without showing my account balance this time because I'm silly, the chain right here. So, no, SPY. Let's go SPY. So, for the example that I had on Friday, there was a double bottom long on Friday. Now, if you remember, this was the double bottom right here. I think it was on the 15-minute chart. So, yes. So, if you were to take that double bottom long, just as an example of what you would be looking for. So, the SPY right here is around 332. So, if you pull up the chain and you were looking at, let's say, Monday's expiry, because Fridays have already expired. So, let's just pretend on Friday you took the Monday options. You wanted to take it long down here at 331.90 something. Let's call it 332. Usually, I like to take the strike that is closest to the money, or just one out of the money. So at like if I had gotten it at 331.94, I probably would have just taken the 332s. The 333 is a little bit far out, so that if it doesn't make it up there by expiry, you're going to get chopped around. So at the money is usually best, or just slightly out of the money. Like if we were at 331.70, 332s would be perfect. So let's just look at the chain here for the 332s. I'm going to pull it up, plop her right here, and we're going to see what they did. So this entry here was at around 10 o'clock. So if we go here, 10 o'clock was the entry. One contract was $1.35. So $135 if you just buy one of them. Now, the ones that expire the same day will be much cheaper. They'll be like 60 or 70 cents. So $70. And if it goes to zero, like if the SPY dumps to like 200, the max that you can lose is the premium that you put in. So $130 on this contract or $70 on the other. It'll just go all the way to zero. You'll lose 100%, but it'll only be $70 because that's all you put in. So you're actually in control of 100 shares of the SPY, so $33,000 worth. But that's just how option contracts work. I'm not going to go into that. I'm going to stay with the strike selection and a typical move. So you want to take the double bottom, let's say, and your target, let's go back up here. Let's say that your target, I don't know where you guys get your targets from. Maybe something as simple as the opening print. So the close or the open of this candle, the opening candle, or even the high of that candle. So it's so easy to train discipline because you have your entry, you have your target, because why would you sell anywhere in here? There's no reason to sell anything in here. Now maybe as you come back up, you set your stop to break even. Okay, sure. But other than that, you should be holding to a primary target, and that's at least up here. So if your risk is $50 per trade, that's all you want to risk. You buy one of these at $1.35 and you put in a 50-cent stop immediately. So this has to go all the way down to 85 cents, and you'll get stopped out for 50 bucks. Now, if you held all the way to target, all the way to the high of this candle here, around 10.25, is that 10.25? Or 11.25? So 10.25, the contract made it all the way up to about $1.80. So you would have made, what is that, 130 up to 180 is 40 cents, right? 130, no, that's 50 cents, 55 cents. So $55, and your risk there was $50. Now, realistically, you can take more risk on an options trade. Like, you don't, it's not going to swing down 50 cents when it's $1.30. So what I would have done is probably taken 3 and put in a 20-cent stop, let's call it. That's $60 worth of risk. And then if you make 50 cents on 3 of them, you've now made $150. So that is a much better risk to reward ratio. But that's when you get more comfortable with how these move. So if it was down in the 30-cent range, you could take 10 of them with a 10-cent stop. But if the contract is all the way up at let's get back to the options chain. If you're taking one of these, let's say the 330s, it's already at $3. So it can move up a higher amount than the lower priced ones. Like, an appropriate stop for a $3 or $4 option is probably 50 cents to $1, probably closer to $1. So what else? What else should I talk about? So that was a good strike selection. So your entry is around 332. You want to take the 332s. And if your target the same day is much higher, like if you thought that this could go to 334, then yes, take a 333 and see what happens. So I would just recommend you guys to look at your favorite stocks. Look at, just pull up Netflix. Whatever it is that you're thinking of trading. You're like, okay, Netflix, I'm going to go long off of this level at the open. So let's pull up the options chain. And we'll look at this Friday's expiry. So if you thought Netflix could make it up to this high of 371, usually I would take the 370s because you still have a lot of time to expiry and it is very close to the target. This is just an example, by the way. I'm just giving you guys examples. You can check it out yourself, come up with your own plan. But if we throw up the, Netflix here, 370s, we'll pull those up, we'll see what they did. So these things went from $4 to $7.50 to $8. So one contract, you buy one contract at the open, because, or okay, this is your setup. I just drew this line, so it comes up, it confirms over your level. When it comes back down, that's where you take the trade. So you take the trade right in here at $4.50. You have $1 stop. Let's even call it $1, because I said above $4, it's usually good to have a $1 stop. So you're in for $400, one contract. You have $100 risk, and your target is, I don't know where the hell your target is. Maybe it's the high of yesterday. So the high of yesterday, it comes up, boom, you sell it. That is at 12.30. I think that's going to be right here. 12.30, it comes up, you sell it in between 7 and 7.50 for the price you sell it. Your risk was $100 and you just made $250 to $300. That's a 2-to-1, 3-to-1, depending on how you look at it, depending on where you sell. Maybe you took 2 contracts here, which is something that I would do for with a 50-cent stop. That's $100 risk, and you ride it up. If you sold both of them there, you just made $500 to $600. So much easier to manage, way less stress than this penny stock crap. It's all crap. Most of it's crap. So I hope that was useful. I say that at the end of every video. Who knows if it was actually useful. But this is what I do. I look at the chain. I always choose the expiry that is expiring the soonest because I'm day trading them. I don't want to pay a premium to pay for, to give myself extra time. Now, if I'm going to swing something, if I think Netflix can get to 370 today, but then next week get to 380, sure, I might take the next week's out. But I only do that on like a Thursday or a Friday, and I play it into the next week. I never go this far out. So with the SPY, it's almost always the same day and the day after, or the next expiry. So if I think that the SPY can make a decent move today, but then into tomorrow, like gap up or gap down, I will change between the soonest expiring and the next soonest expiring. If you have any more questions on options, please leave it down there. I'll tell you what I can. I don't want to go through all of what options are. You guys can look that up yourself, or the Greeks, or what theta is and stuff like that. I'll answer what I can below. Other than that, we'll see you guys later.